the system behind inflation they never explain. But to understand why prices keep rising and why they rarely come back down, you have to look at what actually drives inflation behind the scenes. Not the simplified headline explanation, not the political talking points, not the greed explanations or the supply chain excuses. Inflation has mechanics, and those mechanics involve incentives, power, and structure. Inflation is often described as a single phenomenon, but it is not one thing. It is a collection of forces that overlap and reinforce each other. Economists traditionally divide inflation into three broad categories: demand pull inflation, cost push inflation, and built-in inflation. These categories sound academic, but they translate into daily life very directly. Demand pull inflation is simple: too much money chasing too few goods. This happened in 2021 and 2022 when stimulus checks, increased savings, and pent-up demand collided with limited supply. People bought cars, appliances, furniture, electronics, and travel faster than companies can produce or deliver them. Cost-push inflation is the opposite. Costs rise first, then prices follow. This happened as energy prices spiked, shipping rates soared, and supply chains broke down during the pandemic and after. Companies passed higher costs downstream to consumers. Built-in inflation is the legacy of both. Once higher prices are set, workers demand higher wages. Wages then become a cost. Costs then become justification for maintaining higher prices. The cycle feeds itself. But these three categories only explain the first stage of inflation. They explain why prices rose, but not why prices stayed high, and not why prices rose faster in some sectors than others. After the pandemic shock faded, something new started driving inflation. Economists began calling it profit-led inflation, or margin expansion. While energy and shipping costs fell, prices in many sectors did not fall with them. Instead, companies kept prices elevated and pocketed the difference. In the United States and Europe, corporate profit margins reached multi-decade highs after input costs cooled. Researchers estimated that in some periods, profit expansion accounted for roughly half of observed inflation increases. This dynamic was most visible in food, consumer goods, and manufacturing. Consumers kept paying higher prices because they had already adapted to them. And once consumers normalize a higher price, companies have no incentive to reverse it. This explains something people notice but rarely hear explained. Why are prices still high even though inflation is going down? Because inflation measures the rate of increase, not the level of prices. When inflation slows, it means prices are rising more slowly, not that they are falling. Imagine the price of something jumps from $10 to $12. Then the next year, it goes from $12 to $12.50. Inflation slowed, but the price never returned to $10. This is the part that confuses households, because they experience permanently higher prices, even though the data says inflation is cooling. The price level and the inflation rate are two different realities. The system cares about the rate. Households care about the level. But this is only one layer of the system behind inflation. Another part is logistics. Before the pandemic, global supply chains optimized for efficiency. Products were made in one place, assembled in another, packaged in a third, and sold in a fourth. This system assumes stability, low fuel prices, predictable shipping times, and uninterrupted geopolitical relationships. When that system broke, companies were forced to rebuild supply chains that were more expensive, more domestic, more redundant, more resilient. Resilience costs more than efficiency. If it costs more to move goods, inventory, labor, or inputs, companies will raise prices, even if consumers do not see the new system themselves. Energy also plays a central role in inflation. Energy is not just gasoline. It is heat, electricity, fertilizer, manufacturing input, transportation, and logistics. When energy prices spike, inflation spreads everywhere because energy cost flows into every product on the shelf. And even when energy prices fall, companies often keep new price benchmarks in place. Shipping provides another example. During the pandemic, shipping container costs exploded. The price to move a container from Asia to the United States increased by more than tenfold at one point. Companies raised prices to match. But after shipping rates fell, prices did not return to pre-pandemic levels. Why? Because prices renegotiated during crisis rarely renegotiate downward during recovery. Supply contracts update faster than consumer prices. Another part of the system involves scarcity. Scarcity is profitable. It allows companies to raise prices without backlash, because customers expect limited availability to cost more. Scarcity can be natural or manufactured. Natural scarcity occurs when demand exceeds capacity. Manufactured scarcity occurs when capacity exists but is restricted to maintain margins. Housing shows this clearly. Even though the United States built fewer homes than needed for more than a decade, policymakers largely ignored the supply deficit. When demand surged post-pandemic, prices skyrocketed. Even after demand cooled, the shortage kept prices elevated. Scarcity also appears in healthcare, in childcare, in utilities, in higher education, in pharmaceuticals. These are industries where consumers cannot substitute or delay purchase, which means price increases stick permanently. But inflation does not only depend on scarcity and costs, it depends on power. Price increases require pricing power. Companies need the ability to raise prices without losing customers. Pricing power comes from market structure. When industries consolidate, competition drops. Less competition means more pricing power. From airlines to meat processing to broadband to healthcare to shipping to baby formula, industry consolidation has increased dramatically over the last 20 years, and consolidation makes inflation easier to sustain. When companies have few competitors, they can raise prices without fear of losing market share. When costs fall, they can keep prices elevated without being undercut. This creates what economists call price stickiness. Prices rise fast, but fall slowly, if at all. Sticky prices are not new, but the degree of stickiness in the modern economy is new, and this stickiness is reinforced by investor expectations. Public companies are not judged primarily on stability. They are judged on growth, specifically revenue growth and margin expansion. If a company raises prices during a crisis and investors get used to higher margins, reversing those margins later becomes risky. So, instead of lowering prices, companies maintain new benchmarks and attribute stagnation to market conditions. Under this model, inflation becomes profitable for institutions and painful for households. This reveals something uncomfortable but important. Inflation is not just an economic event. It is a system of incentives. And when incentives align, inflation becomes self-sustaining. If I could ask you to please subscribe, press the bell, leave a like, and a comment. Now let's get back to our video. If inflation were only about input costs, prices would fall when costs fall, but they don't, at least not in the way households expect. This introduces one of the most misunderstood parts of the system. Prices go up quickly, but they do not come down symmetrically. This asymmetry has multiple causes. One cause is contract repricing. Many industries operate on contracts that renew annually or quarterly. When shipping rates, energy prices, or raw material costs spike, suppliers reprice contracts upward. But when those costs fall, contracts do not automatically reset. They wait for renewal. And even at renewal, companies weigh whether reversing prices would weaken margins or investor expectations. If the answer is yes, prices hold. The temporary crisis becomes a permanent baseline. Another cause is cost rebasing, When costs spike, companies reorganize budgets, forecasts, and expense structures around the new price level. This creates new internal cost expectations. If a company absorbed higher costs during the crisis period and used price increases to restore margins, lowering prices afterward would mean compressing those margins again. Most publicly traded companies avoid margin compression unless forced to. Another layer is competitive dynamics. Even in competitive markets, no single company wants to be the first to lower prices. Lowering prices signals weakness to investors, and it trains consumers to expect discounts. Companies prefer to keep prices high and compete on other dimensions: quality, marketing, features, bundles, membership perks. Price becomes the last lever they are willing to adjust. Another layer involves monetary policy incentives. Policymakers often treat inflation as an acceptable tool to manage debt. Inflation erodes the real value of government debt over time. It increases nominal tax revenue without raising tax rates, and it reduces the debt-to-GDP ratio without politically painful cuts. Deflation does the opposite. It increases the real burden of debt. It reduces nominal tax revenue, and it increases pressure on fiscal systems. This is why governments fear deflation more than inflation, and why mild inflation is often tolerated or even targeted. Central banks explicitly target positive inflation rates, not zero, not negative, typically around 2% per year over the long run. This target is not arbitrary. It keeps the system moving. It discourages hoarding cash. It encourages spending and investment. It reduces debt burdens over time. But when inflation escapes the 2% target, it becomes politically sensitive. And when it affects essentials like food, housing, and healthcare, it becomes socially explosive. However, inflation does not hit all sectors equally. During the last several years, inflation in discretionary goods slowed faster than inflation in necessities. This created what analysts called two-speed inflation. Inflation for goods like electronics, clothing, and home goods slowed as supply chains normalized. But inflation for food, rent, utilities, healthcare, and insurance remained elevated or continued rising. Households do not experience inflation evenly. They experience it through necessities first. Essentials have no substitutes. You cannot decide not to eat. You cannot decide not to live somewhere. You cannot decide not to heat your home. You cannot decide not to drive to work if your job requires it. Inflation becomes punitive when it concentrates in non-discretionary categories. This is exactly what happened after the pandemic period. From roughly 2020 to 2024, food prices rose significantly faster than wages. Rent rose significantly faster than wages. Childcare costs rose significantly faster than wages. Health insurance premiums rose significantly faster than wages. These dynamics created a sense of permanent financial stress. But the story does not end there. Another part of the system involves profit expectations. Public companies are not rewarded for stable profits. They are rewarded for expanding them, year after year. If a company increased margins during a crisis, investors begin to treat those margins as the new normal. If the company later reduces prices and compresses margins, investors punish it. This creates a powerful incentive to maintain higher price levels, even when cost pressures subside. Economists describe this as profit-led inflation. Profit-led inflation is most visible in industries where pricing is concentrated: meat processing, airlines, energy, manufacturing, food packaging, shipping, insurance, pharmaceuticals. These industries have few major players, high barriers to entry, and pricing power over households. Pricing power is the ability to raise prices without losing customers. Pricing power often arises from consolidation. When an industry consolidates from 20 competitors to 5, the competitive pressure to lower prices disappears. When it consolidates from 5 to 3, pricing becomes coordinated without needing explicit collusion. When it consolidates from 3 to 2, the market becomes captive. Captive markets make inflation sticky. Pricing does not revert because there is no competitive force pushing it down. Another part of the system involves monopoly and oligopoly effects. Few industries in the United States are true monopolies, but many are oligopolies. A few players dominate the majority of the market. Air travel is an oligopoly. Meat processing is an oligopoly. Shipping is an oligopoly. Baby formula is an oligopoly. Broadband internet is an oligopoly. Pharmaceutical distribution is an oligopoly. Oligopolies do not behave like competitive markets. They do not race to the bottom on price. They race to the top on margin. This shifts the inflation system from cost-driven to incentive-driven. When inflation is cost-driven, it eventually reverses when costs reverse. When inflation is profit-driven, it does not reverse unless incentives reverse. Incentives rarely reverse on their own. Another layer of inflation involves housing. Housing is the largest expense for most households, and housing inflation behaves differently than other categories. Housing inflation is driven by supply constraints, zoning restrictions, construction bottlenecks, labor shortages, and financialization. Financialization means housing becomes an investment vehicle rather than a shelter good. When institutional investors purchase homes and convert them into rentals, supply shrinks. When short-term rental platforms remove housing from the long-term market, supply shrinks. When zoning laws restrict dense housing, supply shrinks. Lower supply means higher rents. Higher rents mean inflation sticks longer. Housing inflation is powerful because it cascades into other categories. If rent rises, disposable income falls. If disposable income falls, households delay discretionary spending. If discretionary spending slows, companies respond by raising prices to maintain margins. Demand shifts, but inflation persists. This is another reason inflation has felt different in recent years. The system behind inflation is no longer contained to one sector or one cause. It is distributed across multiple sectors that reinforce each other. Food, housing, healthcare, insurance, energy, utilities. These are not luxuries. They are mandatory expenses. When inflation concentrates in mandatory expenses, it becomes a structural issue rather than a cyclical issue. This is the part of inflation that policymakers tend to understate. They focus on headline numbers, not lived experience. Headline inflation may fall from 8% to 3%, but if rent, food, and insurance continue rising, households do not feel relief. Inflation becomes a chronic condition, not an acute event. And chronic inflation has lasting social effects. People delay families, delay homeownership, delay healthcare, delay education. They reduce savings, increase debt, work more hours, take on side work. Disposable income collapses, and stress becomes normalized. This is the inflation system behind the headlines. Once you understand how inflation really works, the obvious question becomes, what can actually change it? For most people, this question defaults to despair. They assume nothing can change because the system feels too large and too entrenched to influence. But that perception only exists because most people are taught inflation is accidental, natural, or mysterious. It isn't mysterious, it isn't natural, and it isn't accidental. Because inflation has mechanics, it also has levers. Some levers are structural, others are household level. Neither can reverse inflation entirely, but both can influence exposure. Let's start with structural levers. Structural levers require policy, enforcement, or institutional changes. They operate at the level of industries, incentives, and competition. The first structural lever is supply. Housing inflation, for example, is primarily a supply problem. For more than a decade, new housing construction lagged well behind population growth. When supply falls short for long enough, inflation becomes inevitable. Increasing supply is not instant, but it is effective. More housing supply reduces bargaining power for landlords, reduces scarcity, and slows rent inflation. Cities that increased housing supply saw slower rent growth than those that restricted it. This is not ideology, it is basic economics. The second structural lever is competition. Industries with more competitors have lower and less persistent inflation. When airlines consolidate, airfare becomes sticky. When pharmacies consolidate, drug prices become sticky. When broadband consolidates, internet costs become sticky. Antitrust enforcement is not merely about fairness. It is about price dynamics. When industries consolidate, price increases stick. When industries compete, price increases erode. The third structural lever is transparency. Opaque pricing enables inflation. Healthcare is the most extreme example. Patients do not know the price of procedures. They do not know the price of drugs. They do not know the price of insurance reimbursements. They do not know the price of out-of-network charges. The same hospital charges different patients dramatically different prices for the same procedure based on insurance and negotiation power. Opacity makes inflation unaccountable. Transparency makes inflation contestable. The fourth structural lever is margin discipline. Profit-led inflation emerges when investors reward companies for raising prices faster than costs. Policies that discourage excess margin expansion, such as price caps in non-competitive markets, windfall profit taxes, or competitive procurement rules, can reduce inflation without reducing output. These policies are not anti-business. They are anti-extraction. The fifth structural lever is data governance. Price discrimination and dynamic pricing operate on data. When companies can profile customers, they can charge different prices quietly. Limiting behavioral profiling reduces extraction. These structural levers do not eliminate inflation, but they reduce its stickiness. They reduce its regressiveness. They reduce its persistence. But households also have levers. Not because households are responsible for inflation, but because households can reduce their exposure to it. And exposure is what households actually feel. The first household lever is timing. Companies price differently across time, not just across customers. Buying non-perishables when they are on promotion can drastically reduce annual grocery inflation exposure. This is not couponing, it is timing arbitrage. The second household lever is substitution. Substitution is not about buying worse products. It is about bypassing extraction channels. Many highly inflated categories have functional substitutes that are less inflated. For example, switching from pre-cut produce to whole produce bypasses labor inflation. Switching from branded pharmaceuticals to generics bypasses pricing power. Switching from delivery to pickup bypasses convenience fees. Substitution does not solve inflation, but it reduces extraction. The third household lever is liquidity prioritization. Liquidity is the ability to pay up front. Inflation punishes households without liquidity through monthly premiums, late fees, annual percentage rates, and urgency premiums. Households that increase liquidity modestly can bypass some of these costs. This does not require more money. It requires changing the order in which obligations are paid. The fourth household lever is debt sequencing. Not all debt is equal under inflation. Fixed-rate debt becomes cheaper in real terms as inflation rises. Variable-rate debt becomes more expensive in real terms as rates rise. Prioritizing variable-rate paydown minimizes exposure. Letting fixed-rate debt amortize naturally maximizes inflation benefits. This is not financial advice. This is inflation math. The fifth household lever is subscription compression. Subscriptions are inflation vectors. Companies raise subscription prices continuously because churn is low and customers rarely reevaluate. Households that compress subscriptions annually reduce inflation exposure without reducing quality of life. None of these household levers fix inflation because households do not cause inflation, but they reduce harm, and reducing harm matters when inflation becomes chronic. Chronic inflation reshapes society in ways that are rarely acknowledged. It changes how people think about the future. It changes how they plan. It changes how they define success. It changes how they define stability. Inflation is not merely an economic phenomenon. It is a psychological phenomenon, a political phenomenon, a structural phenomenon. Most importantly, it is a system of incentives, and systems of incentives do not change until enough people understand how they work. Once you understand the system behind inflation, the narrative shifts. The question stops being, "Why am I falling behind?" and becomes, "Why is the system designed this way?" That shift is powerful because it replaces self-blame with clarity, and clarity is the beginning of agency. If you want to keep breaking down how this system works, subscribe so you don't miss the next part of this series.